3-minute trader tip, key clues in market risk assessment. Now, we've talked about the need for assessing market risk previously. What we want to do now is look for various clues that are going to help us in the task of making a judgment or assessment of overall market risk. Firstly, and most obviously, we can look at price action and overall sentiment, so things like candle structure and momentum, on key asset classes. If you've been to sessions that we run, for example, the daily updates or inner circle sessions, you'll see this is where we often start. And we'll look at what the major indices are doing. We'll look at what major commodity groups are doing and the major currencies. And from that, we can start to get a picture about where the market is in terms of, have we a sentiment or a trend that's going to continue or perhaps is under threat? Either way, from being a negative sentiment which could change to a positive sentiment or vice versa. And we can see this using price action as we suggested. And potentially some indicators. For example, we've talked before about the MACD signal line moving over a histogram being potentially an exit for a long trade. Perhaps this could be an indication that market risk is changing. Or generally speaking, markets tend to be data driven. So as new information comes onto the market will interpret that and then recalibrate its thinking in terms of what particular assets and asset classes are worth and whether that is a significant change or otherwise. Now, clearly, we have differences in data types. But of course, one of the advantages of a data-driven market is that we know when these events are going to happen. However, when there's a significant market shock that's outside of data, for example, a political situation, some conflict, the Ukrainian conflict was a great example of this recently, or perhaps a terrorist event, what happens is markets change from being data-driven to being headline-driven, which means that it adds a layer of market risk, is that we don't know when those headlines come out, and nor do we know what they're going to be to the same degree as we may have an idea with some data. Another clue is predictable market event proximity. So this relates to the data. If it is a data-driven market, when's that going to come out? And of course, what is the significance of that data to the overall market? So for example, an inflation number coming out of the US in an inflation-sensitive market, we know when that's coming out, and we know that on those days, the market risk is going to be higher, potentially for a move away from current pricing. We can look at the major futures contracts in equities, both US and European, not only in terms of direction, but also the level, so the degree to which there's a change from the previous day, to give us an indication about what might happen when the markets open next, particularly when you're trading shares or share CFDs where there may be the potential for gap in the following day. If futures are, say, pointing dramatically negative, perhaps it's worthwhile assessing the market as high risk and altering your behavior accordingly. And then, of course, we've got the Vix Index, or the Fear Index as it's sometimes called. This is a tradable instrument, but also is essentially a mirror image in the way it moves to the S&P 500. And hence, if the S&P 500 is going down or increased uncertainty, then the VIX is likely to rise, and vice versa. So if we're in a situation, for example, where the VIX perhaps is elevated, is moved up slightly, that would say markets are becoming increasingly uncertain and hence there's higher risk. So a combination of these clues can enable us to make at least some sort of judgment of assessment of market risk in the short term. Trade safe, and we'll see you again soon. Bye-bye for now.